Coca-Cola has always been one of the most predictable companies in the market. A global brand with enormous scale, strong distribution, and pricing power. But that old formula may be changing. The latest earnings report showed stronger demand, but the numbers alone aren't the interesting part. What's more important is what's happening underneath them. Coca-Cola is adapting its portfolio to changing consumer preferences, redesigning its approach to affordability, accelerating local innovation, and using consumer data to make its global system more responsive. At the same time, management raised its outlook. So this may not simply be another strong quarter for a mature consumer company. It could be an early signal that Coca-Cola is building a different growth engine. And that raises the real question. What exactly changed, and can it last? For years, Coca-Cola's growth model was relatively straightforward. Build powerful brands, expand distribution, raise prices, and let scale convert that revenue into predictable earnings. That model worked extremely well. But the consumer environment is becoming more complicated. Lower-income consumers are becoming more sensitive to affordability, while higher-income consumers are increasingly looking for healthier, premium, or more specialized choices. At the same time, beverage preferences are changing faster than they once did. That creates a challenge for a company of Coca-Cola's size. Pricing power alone cannot solve every problem. The opportunity is to become more adaptive without giving up the advantages of scale. And that is the strategic shift to watch. Coca-Cola is moving from simply monetizing its brands to continuously adapting them to the consumer. The biggest change inside Coca-Cola may not be a new product. It may be the way the company is organized to find and scale growth. Henrique Braun became CEO in March, bringing experience across markets, supply chains, marketing, innovation, and bottling. Under his leadership, Coca-Cola has been emphasizing local consumer insight, innovation hubs, digital capabilities, and faster execution. The idea is simple. A global company cannot assume that consumers in every market want the same thing at the same price. Instead, Coca-Cola wants local teams to identify what is working, then use the company's global scale to expand those ideas faster. That could make innovation less dependent on occasional product launches. The real bet is that a more adaptive organization can turn Coca-Cola's enormous scale into a growth advantage, not a source of organizational inertia. Coca-Cola's scale has always been one of its greatest advantages. But scale can also create distance from the consumer. What works in the United States may not work in India, Brazil, or Indonesia. That's why Coca-Cola is increasingly pushing decision-making closer to local markets, while keeping its global distribution and brand infrastructure intact. The strategic advantage is the combination. Local teams can identify changing tastes, price sensitivity, and emerging occasions faster. Then Coca-Cola can use its global system to scale successful ideas across markets. That creates a potentially powerful feedback loop. Local insight, faster innovation, global distribution, and faster learning. The goal isn't simply to launch more products. It's to reduce the time between discovering what consumers want and turning that insight into revenue. If Coca-Cola can do that consistently, its scale becomes a growth accelerator rather than just a defensive moat. Coke Zero is important for a reason that goes beyond its 16% volume growth. It shows Coca-Cola can adapt to a major change in consumer preference without losing the underlying category. Consumers don't necessarily want to stop drinking carbonated beverages. Many are simply looking for lower sugar alternatives. Coca-Cola can capture that migration within its own portfolio, rather than allowing consumers to move to another brand. That's where the company's moat becomes important. Its brands, distribution, shelf presence, and marketing scale allow Coca-Cola to introduce a new proposition while keeping consumers inside the ecosystem. So the opportunity isn't simply selling more Coke Zero. It's protecting the broader beverage franchise as consumer preferences evolve. That makes zero sugar less of a product trend, and more of a strategic growth engine. The consumer Coca-Cola serves is becoming more divided. Some consumers remain willing to pay for premium products and convenience. Others are under pressure and increasingly focused on affordability. Coca-Cola's response is not simply to lower prices. Instead, the company is using different pack sizes and price points to reach different consumers while protecting the value of its brands. That distinction is important. A blanket price cut could damage margins and weaken pricing power. A smarter price architecture allows Coca-Cola to offer an affordable entry point without abandoning premium consumers. This is especially important in emerging markets, where small changes in purchasing power can quickly affect consumption. The strategy is not to choose between premiumization and affordability. It's to serve both without destroying the economics of the brand. India provides an important reality check for Coca-Cola's growth strategy. Demand for the company's beverages remains strong, but Coca-Cola has been losing value share. The problem highlights something deeper than pricing. Management indicated that the company had not fully met demand at some mid-tier price points. In other words, consumers may want the product, but the right pack and price combination isn't always available. That exposes a weakness in Coca-Cola's affordability strategy. The company can have a powerful brand and strong consumer demand, yet still lose share if its product architecture doesn't match what consumers can afford. This is why India matters beyond one market. Coca-Cola's next phase of growth depends not only on understanding consumers, but on delivering the right product, pack, and price at scale. The improvement in Coca-Cola's profitability has a deeper story than simply raising prices. Management has been reshaping the economics of the business through productivity, operating discipline, and refranchising. That last piece matters. By moving more bottling operations to independent partners, Coca-Cola reduces exposure to the capital intensity and operating costs of directly owned bottling businesses. At the same time, the company continues investing in marketing and innovation. So the margin improvement reflects both revenue growth and a more efficient operating structure. The key question isn't whether Coca-Cola can expand margins for one quarter. It's whether the company is becoming structurally better at converting its enormous brand and distribution scale into earnings. That is the part of the margin story investors should watch. The World Cup matters to Coca-Cola for a reason that goes beyond short-term sales. The company is using the event as a global platform to connect local consumer activation with its broader digital ecosystem. That creates something potentially more valuable than temporary demand: consumer intelligence. Through connected packaging, digital engagement, and local campaigns, Coca-Cola can learn more about what consumers respond to, where they engage, and which ideas can be scaled. This creates a feedback loop. Global event, local execution, consumer data, and faster learning. But there is an important caveat. The World Cup is temporary, so investors should not assume every benefit will continue after the tournament. The real test is whether Coca-Cola can convert the learning from this event into better innovation and consumer engagement long after the spotlight disappears. The most revealing signal may be what management did after seeing the first half. Coca-Cola raised its full-year outlook. That decision suggests management is not viewing the stronger results as an isolated quarter. The confidence appears to come from several factors working together: better consumer engagement, stronger execution, innovation, and improved operating efficiency. But the important point is not the guidance number itself. It's the change in management's assumptions. Management now believes the business can deliver stronger results despite an uneven consumer environment and continued cost pressures. That tells us something about internal confidence. Coca-Cola isn't simply reporting that the business performed better. Management is saying the underlying conditions are strong enough to raise expectations for the rest of the year. That is a much more important signal for investors. The stronger growth story still has to pass an important test: sustainability. Some of Coca-Cola's recent momentum is connected to factors that won't repeat indefinitely. The World Cup creates exceptional consumer engagement, while easier comparisons and favorable conditions can also support short-term results. At the same time, Coca-Cola still faces higher input costs, currency pressure, and uneven consumer spending across markets. That means investors should separate the structural improvements from the temporary ones. The structural opportunity is the new operating model: faster innovation, better consumer insight, smarter affordability, and stronger execution. The temporary opportunity comes from events and favorable conditions. The real test begins when those temporary benefits fade. If Coca-Cola can maintain healthy demand without them, then the market may have identified a genuine improvement in the company's growth engine. This is where the earnings story becomes a market story. Before the report, Coca-Cola was largely viewed as a mature defensive company whose growth depended heavily on pricing power. The latest results challenge that assumption. Investors are now seeing evidence that Coca-Cola can adapt its portfolio, respond to affordability, use consumer insight, and improve operating efficiency while still benefiting from its global scale. That changes the quality of the growth story. The market isn't necessarily saying Coca-Cola has suddenly become a high-growth company. It is asking whether the company's growth engine has become more adaptable, and therefore more durable, than previously assumed. That is the potential repricing happening underneath the earnings reaction. The numbers confirm the quarter. But the changing perception of future growth is what makes this report more important. Coca-Cola's latest quarter doesn't prove that the company has become a high-growth business. What it does show is something more interesting. Coca-Cola appears to be building a more adaptive growth engine, one that combines global scale with local consumer insight, faster innovation, smarter affordability, and a more efficient operating structure. That could make the company's growth less dependent on simply raising prices. But the next few quarters will determine whether this is a structural change or just a strong moment supported by temporary catalysts. And that's where the market's expectations now become important. Coca-Cola may have broken the old script. The real question is whether management can write a new one, and deliver it consistently. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.